Hello and welcome to PGurus Prime Time special episode on US stimulus. Sridhar Chityala ji, Namaskaram and welcome to PGurus Prime Time.
Namaskar, and again, good morning to everybody, or late good evening to everybody, or early good morning to some. Okay, looking forward to the session. Thank you.
I want to first set the stage for all our viewers that this will be part of our membership program from 1st March onwards. We will be allowing people who are members to watch these special segments. The normal programming will continue, but those who want to know the special things, for example, in this particular episode, we are going to talk about the US stimulus. There have been multiple stimuli packages that have been made available for the United States people, how it's going to affect, which ones have a better chance of improving the overall economy and the lifestyle for good, and which ones perhaps are not that good. All that stuff, we are going to sift the grain from the chaff, and all this stuff is going to be made available with the man who's a wizard with numbers, Sridhar Chityala ji. Sridhar ji, let's take a look at all the different US stimulus packages that have been given since COVID started. And you can start from there, sir, and take us through and to where we got the latest one signed yesterday. The details are not there yet, but at least you have the top line, which is $1.9 trillion.
Right, right. So I think we'll go through the sequence of the three stimulus programs, the impact to the budget, the 2020 projections, etc., etc. So there is a sequence of dollars allocated and the consequence to the economics of the US GDP, debt, and so on and so forth. So I think that's the objective. So our first chart is the total estimated impact of major COVID programs. So I'm assuming that because I don't see your screen, so that's the diagram that's going to pop up.
Yes, yes, yes. And it is
Uh,
up now. It is up
it,
now. Yeah.
okay, so you will see that there is three programs that occurred during the first leading up to December. The first program is called as the CARES Act, which is COVID relief program, and then you had the second, which is around the extension of the healthcare extension on the back of the PPP, which is the 355 billion for the small business. And then you have the third program, which is called as the Response Relief and Recovery Act, which is the 915. So broadly, you can see they are categorized into a small business, and then you have four categories of direct payments. One is the support for the unemployment. Then you have the direct cash, which is, and then you also have the healthcare, the relief or rebates that come with it, etc. Then you have the local and state administration, which is effectively supporting the communities. Then you have the tax relief, especially for the child supplement support, etc., etc. So very clearly categorized list of programs, and we will be studying later as to which one and what economic impact that they have. So if you kind of flow it across this 1.9 plus 355 plus 915 billion, then you'll see that the highest ticket item that is for the small business, which is roughly 935. Some of these cells may not add up because we have extracted the data from the research, and some of them are rounded to kind of the highest $5 billion. So some people had commented they don't add, the rows don't add, but that's just the rough indication. The unemployment benefits, which is the highest, 590 billion. Recovery rebates is 460 billion. The healthcare, which is 420 without the stimulus three. So you have broadly very well categorized, directed type of programs. The question that is asked is, are all these programs very efficient and effective? Many of them are. Some of them, as is always the case with many countries, some of them don't get directed properly and becomes a wastage. But at least in this stimulus program, by directing it at small business and by directing it directly, by giving funds directly into the hands of the people, and the unemployment insurance, the rental moratorium, the child care support, we have seen the money flow back into the economy by virtue of these programs. So these three programs translates into $3.4 trillion roughly in the total kind of stimuli that was inducted into the US economy as at December 2020.
Now, let's take a look at what has been coming down the pipeline as far as Biden's proposal is concerned. The first stimulus package is 1.9 trillion. Now, in addition to all this, there is a $120 billion money being pumped in by Treasury, isn't it? There is also.
Yeah. See, the corporates, you need to have credit flowing. This is focusing on individuals and small businesses. The credit needs to flow into the mid corporates and large corporates, more specifically the mid corporates. Mid corporates are those which are in United States, 20 million to 500 billion dollars. In some cases, even 200 billion dollars top line revenues, right? So those are the top line sales. So these are the segment of the industry which requires support. They require support by way of credit extensions. So what Fed is saying, and even for large corporations, what Fed is saying is that they have $120 billion monthly asset purchase program that helps to unlock the credit in the market so that the economy continues to have liquidity available across all spectrums of the consumption, so across all spectrums of the supply side of the ledger, which is namely small business, mid corporates, large corporates, and then of course institutions themselves.
So now I have the fiscal year totals that's
Yeah.
come up now, and we are looking at first the spending, and the spending has come up to $6.6 trillion. So
Correct.
that's where I am, sir. Please continue.
Okay, so what the objective is to translate what has been injected, like 3.4 trillion, translate that into numbers from a budget point of view, because you always have to add the numbers to the existing budget in terms of what the impact is. So when you see the full year 2020 numbers, you will see that the three top line items in this instance, which is namely the Social Security, Medicare, and Medicaid, and similarly you will also see down below the military spending. Most of them have remained kind of relatively stable, and the only growth is by virtue of uh, the new people either coming into the population, coming into that 8 grand programs, or there is increments in people retiring, and which contributes to the Social Security and Medicare. So those line items remain the same. So where has these additions been? You can see the first is in the economic rebates. These are the ones that was given by way of credits. Then you see the coronavirus relief fund. This typically you will not find in the budget item, but you see that there is $149 billion that's allocated, because that's going to be incurred and spent. What is here is incurred and spent. Part of the 2020 R&R stimulus, only some part of it will get added. You will see much of that captured when we present the 2021 budget. Okay, then you'll see the unemployment benefits, which was only $32 billion. That went up to about $476 billion given across 2 specific programs. Then the small business, which received the highest, is about, if you saw small business, when we added 2019, first, second, third stimulus, is roughly about $900 billion. But here we have only factored in 577 billion, because some of that goes into the next year, which is the current year. The objective is not to go through line item by line item, but to tell you that there is a fine mathematics in terms of, we can track all these numbers in terms of how the numbers move from stimulus into the overall budget, which in turn goes into the debt as well as into how the GDP is computed. One specific line item, this is, we bankers take pride in this, which is namely our ability to, retweak and rebalance the debt. Steve Mnuchin comes from the Goldman Sachs, a very successful mortgage MBA business. And interest on debt. You look at the interest on debt. We were about $23 trillion at the end of 2019. You will see it in a chart. Our interest costs were $376 billion. And then when we come to end of 2020, you will see that we are at around $27.5 trillion. So we've increased the debt, but we have reduced the interest costs to $345 billion. This is a very important facet as to how we need to continue to manage the balance sheet of the government very similar to we manage the balance sheet of corporations. We constantly manage to see we maximize the rate cycles, and we see how we can roll our debt and refinance our debt so that the cost of debt is manageable.
Now, I'm also looking at, right now I have put up the revenue and the deficit on front of the viewers. Now, one question I have is that you mentioned about the interest on the debt. Now, the rates have now come down to zero. There is no more room to move unless in United States start thinking of negative interest rates. If the next US stimulus package comes along, how will they try to balance this part, the interest on
Uh,
the debt?
yeah, this is the interest on the debt amortized currently as it stands rolled over.
Right.
Okay, so there will be a similar program that would be put in place depending on how the new debt is funded. Okay, when the new debt gets funded, this becomes an interest. The new debt is an interest overlay on the current debt, which is restructured. I think I had mentioned before, roughly, the interest costs are about 3.4 to 3.5%, or even 3.2 to 3.5% of the GDP. The GDP is roughly around is around 21 trillion. If you take that 21 trillion and then you apply 3%, this number should be close to $600 billion, not $345 billion. So in other words, it's somewhere around the 1.5 mark, the 1.5% of roughly the GDP. If you take $22 trillion as the rough kind of the GDP today, which it is 21.4 to 20.8 by the time we finish. So the story is that what it's showing is that there is close to $200 billion of interest cost by virtue of leveraging the 0% rate has been released. So one of the questions that people ask is, are you going to reduce and repay the loan? We are going to continue to work towards reducing the deficit. So we are not adding more debt to the existing balance sheet while we continue to grow our income from taxes. And our average growth is between 3 to 4%. So this is how this fine principle is. This is how the balance sheet is managed. The question of selling assets and repaying the debt does not arise in United States. It's about how we manage the debt as an integral principle. Now, the question that is asked is, your reserves are low, your debt is high. Therefore, how do you then, whereas every other major economy like China or Japan, Switzerland, India even today is close to $600 billion in reserves, how does United States manage? US is a very different animal. It's a true free market. Most of the reserves actually sit in large corporations. Banks hold roughly about $4.4 trillion. Then when you take a look at some of these tech companies, they are bigger than many governments in terms of the cash that is held by many of these corporations. So what is not sitting as a reserve in the government balance sheet is actually sitting in large corporations. And also there's a significant amount of money sitting in our money market accounts, which typically we always go to those accounts as the basis for determining the balance sheet of the whole US economic system. Now, I've given you a long-winded answer to your simple question as to how you manage the interest costs on the debt. How will they manage the interest costs on the debt? Now, how Janet Yellen is going to manage the interest costs on the debt, that is her prerogative, which we will be seeing for the first time as a central banker. I have given you the view of how Steve Mnuchin has kind of managed, which is typically how we manage debt when I am managing a large pool of large pool of debt within a large financial institution. This is what I've done, when I was back in my days in JP Morgan or Citibank or, Wells Fargo or an advisor. So we're always looking to see how to reduce a buck here, a buck there, especially on the interest costs.
Now, let's take a look at total revenue.
Mm.
Despite a pandemic in place and ravaging the entire economy, remember that United States is a service sector based economy. 65-70% is service sector. And that has taken a major hit because of COVID. The revenues are not too bad. 2019 was 3.5 trillion, 2020 was 3.4 trillion. So in terms of the V-shaped recovery, the United States actually has bounced back. And even though the deficit looks large for 2020, the 2021 deficit should be significantly lower. What are your thoughts? And I'm just asking you for some projections here because we don't know, but at least it looks like US has bounced back.
In an economic context, US has bounced back. The GDP growth projected for 2021 ranges from 4.3% on the Fed to 5% on Goldman Sachs. The projection for 2022 is roughly between 3 to 4%. I would say 3%. The markets are expected to grow S&P by 14% in 2021 this year, and roughly around between 4 to 7% in 2022. So therefore, there is definitely, in terms of the buoyancy of the economy, both on the GDP as well as the markets, augurs well by virtue of all this stimulus or excess cash that is injected, or cash that is injected into the system, substituting whatever has been lost by virtue of economic shutdown. Okay, so there is a vintage effect. As far as what is going to be the consequence of the growth in the debt, well, we still have to factor in the $1.9 trillion stimulus that is just getting finalized. Okay, by February 16th, we'll have the final clear number in term. They've got a guideline to work within 1.9. The resolutions and the amendments that are passed basically says you stick within the specific boundaries. So the question is, therefore, is what's the line item? We'll know. What exactly they'll finish, I can guarantee you, given these are Democrats, we may finish at 1.91 trillion, but we won't finish at 1.89 trillion. Okay, we won't. So we'll be fully kind of absorbed. The unused 350 or $400 billion that you saw in the Trump administration, which was sent back to the Treasury, and the Democrats said, no, we need the money, keep the money, we need the money. He said, no, it is not spent, I'm sending it back to Treasury. You pass a House resolution, you will get it. To answer your question on the total kind of where we are going with the debt, if you see the guidelines says this is not the end. We are going to come back with another resolution by end of the year. I don't know whether we are going to have another 2 trillion or another 3 trillion added, because we have more programs to add, including clean energy, green energy, and all those kinds of wonderful things, environmentally protected buildings, and clean water, you name it. It's all clean, clean, clean. So we're going to spend a lot of money. So how much of that money is going to come? We don't know as yet. But a number from $2 to $4 trillion is projected. So here are the three things. One, the 2 trillion that we are injecting has to be factored in. Number one, the deficit that is going to come has to be factored in as we look at the 2021 budget. Three, the more stimulus that is coming in, or the more executive orders that is coming in to treat the other programs that I just mentioned, those have to be factored in. So we don't have a line of sight what that projection looks like. But if I have to predict, you can safely take it another $3 to $4 trillion will be added. My bet is by the time we finish 2021, we'll be close to $31 trillion by way of total debt in the balance sheet of the US government.
So which segues me to the next graphic, which is the public debt of the United States. I have the graphic up from December 2019 to December 2020, the last quarter for which we have the data. And I can easily see that now it is close to 27.75 trillion at the end of last year. And with these things coming into play, we are looking into crossing into the 30 trillion range, right?
Yeah. We added $4.7 trillion in 2020, and which is understandable given the pandemic and given all the challenges that we have had. But the great news is that it has done what it is supposed to do, but not to bend it into an inverted V. An inverted V with a debt would have been a disaster for U.S. economy.
Thank you, sir. And I'm putting up the next slide data point here, which is the estimated GDP boost from COVID. We have three different columns: the low end, the center, the mid end, and the high end. And we don't know which one is really going to be the final ones. But I would like you to perhaps walk us through this. And I think we still have to look at which is the better way, the way the Trump administration did the stimulus versus the way the Biden administration did it or is trying to do. We will come to that in a little bit, but we are still going through the existing data. So that's what I have now, the estimated GDP boost from COVID, sir. Take it away.
Look, I think it would be inappropriate to compare both. But I come from the markets. I'm a fiscal conservative. I look at directing the money. This is my personal belief: directing the money that creates economic outcome, and then the markets and the industry begin to contribute towards the development. Democrats have a very have a philosophically different approach, which is effectively to say, while as much as you should do on the fiscally prudent, it's important for people to actually make sure that we are compassionate, take care of people, blah blah blah. So therefore, we increase taxes. One is increase taxes. The other one is you cut taxes. When you cut taxes, you grow. When you increase taxes, it becomes the burden of the government to basically support the programs and in case there's a fall. So this is a philosophically different kind of an approach. We will begin to see how the Democrats manage 2021. The fact that they are coming on the back of a phenomenal kind of a stimulus that has had what you call as the tailwinds, which is pushing the aircraft forward. So 2021 is going to be a very good year for Mr. Biden, irrespective of what he does within an economic kind of a context. Okay, the stimulus is only further helping. Now, what are these numbers? Yeah, sorry.
Sorry, so I'm just taking a simpleton's look at the numbers. Let's take the first row, unemployment benefits. The fiscal impact is $120 billion, and the economic impact, low end is 80 billion, and high is 155 billion. So the reigning wisdom there appears to be that whatever money you give as unemployment benefit will find its way back into the system. And if you look at the Paycheck Protection Program, 320 going in, 140 to 160 is what's going to come back into the GDP. So is my reading correct, sir?
Your reading is very correct, because what it basically says is that your reading is pretty correct. So why there is a correlation difference or a variance between the payroll paycheck program versus this? Part of it is deducted as a tax and goes into the revenue side of the balance sheet. Then part of that is basically the flow-on effect of delay. Suppose I'm giving the number. Look, if I give cash into somebody's hands, the money is going to be sent within a month or two. If I'm giving a payroll, there's a vintage effect that flows into 3-4 months. So what we are seeing here is the effectiveness of the impact as a multiplier, both lagging of the time. That's number one part of it. The second is the inefficiencies. Some businesses may not sustain. They may kind of go down, notwithstanding there is a protection clause. There's a protection clause which says that people who are availing this program should retain their staff for X period of time. So quite a few people have received the PPP, but that has not been adequate for them. So in a best scenario, you expect an 80% effect. In the mid scenario, you expect a 66% effect. And in the worst kind of a lowest scenario, 56 kind of a percent kind of an effect. So you will again begin to see, when you measure this, it's not just purely the people who have received the benefit, it's also the people who have not received the benefit. So there's a lot of people who have said, I am not a PPP beneficiary, I'm not going to sustain, right? So therefore, you have to factor that effect, or you have to factor that number also into account when you look at the overall the impact of the program.
Now let's take a look at the V-shaped recovery that is happening in the American economy. And this projects it out up to 2023 third quarter. You know this V-shaped recovery chart, so please take it away, sir.
Right. I think that there are two important points that I would like to, bring forth to your attention. The first point is that you can see the stimulus that was introduced late Q1, and when the market kind of began to dip around the lower side of the V, we saw that what kind of GDP numbers it was resulting in. At one point we were looking at 19.5, 19.4 trillion dollars GDP when we looked at Q2, Q3, Q2, and yeah, late to mid Q3, we were looking at a projection of 19.4 to 19.6, 19.7 trillion. This is coming on the back of a 2019 GDP number of roughly 21.43 trillion. You will see these numbers when you go to the next set of charts, but I'm just recalling from the memory. But that effect, the GDP coming back reflects that the stimulus has had the desired kind of an effect. There are two other parameters which we have not shared here, but probably in the report which Sree, which PGurus published, we will add those two. One is the unemployment, which went up to 14.9%, came down to about 6.7% during the same two-quarter cycle. This is where the directed PPP programs as well as the asset purchase programs that Fed launched. So that's number one kind of additional variable. The second variable is the retail sales. When the wheat dip started, the retail sales again went back to the pre-pandemic levels by the time we finished the second quarter. So you saw the GDP, the correlating unemployment dip going back, unemployment levels dropping, and then of course the retail sales picking up. Now you go back and analyze the retail sales of all the major retailers, the Q3 earnings and the Q4 earnings. You will see that they had record earnings, especially the online retailers, including people like Walmart, Target, and so on. Record earnings. Now, you saw we talked about the Amazon earnings in the Q4. They said, we're not going to repeat this in Q4. Our Q1 earnings is going to be, sales was 125 billion, came from all their infrastructure stuff as well as from the retail side of the business, something similar. So this is a reflection that the stimulus worked, and the pandemic, notwithstanding the fact the pandemic was not, the vaccine was announced, but during this period, this stimulus, the large targeted stimulus allowed, which is close to 10% of the GDP, allowed the economy to regain back. The three charts, the three curves that you see, is the blue curve is adjusted for inflation. Then the dark blue, which you see, is the one which is the gradient path of the normal GDP pre-pandemic. Then you see the dotted ones as to how it peaked and then how it is being normalized or harmonized relative to the normalized GDP if there was no kind of pandemic. So this is the impact of the stimulus programs and the consequential growth. If you recall, in one of the discussions, Sri Iyerji, that we had talked about that it won't be 2022 before we go back to the 2019 level GDP. This is one of our observations at that point of time, right? But that's going to change. We're going to be back in almost in 2021, back to crossing the 2019 numbers.
And I have the next chart put up here. It is the United States gross domestic product from 1985 and projected outwards to 2025. And that bears out what you're saying, because I'd like viewers' attention to be looking at what is the GDP in 2019. It is 21.43 trillion. In 2020, it went down to 20.8 trillion. And in 2021, it is going to come back to 21.9 trillion. which is a half a trillion more than what it was in 2019. So United States has managed to come back quite nicely, isn't it?
It is. I think that the recovery is back. Um, and I think many of these things that which we have been speaking to, especially the Indian market and Indian economists and policymakers and decision makers. We have had even one session, a fireside chat discussion with Mr. Nalapat, Dr. Nalapat and Mohandas Pai. We said, this is the time to borrow. This is the time for India to borrow when the rates are low and borrow from outside. I know there are pundits who believe that only you have to do from within India. We said, no, borrow outside because the rates are low. Your sovereignty is intact, and there's nothing is going to happen to the sovereign nation of India and then give it the impetus. I think they have now brought it close to 10%. And I haven't looked at in detail the extent of the borrowing, but somewhere close to 10% of the GDP is the Indian borrowing as well. So therefore, I think that is some of the other countries are in a little worse space. They were in a little worse space even before the pandemic started, because they still have been recovering from they've been recovering from quite a bit of issues and challenges that has come out of a range of structural issues, as well as, this is Europe I'm referring to, structural issues and so on. Asia seems to be fine. They will be back after a year or so after the contraction. Europe is going to take a little time in terms of the heavy borrowing that has happened. It's also very asymmetric. European Union is very asymmetric set of economies. But on the US side, I think there is very positive buoyancy right now from a GDP point of view.
And I think what we are saying is it's too early to say whether the 1.9 trillion bill that has been passed by Biden is going to, push this thing along the same path, or is it going to apply the brakes? Because the devil is in the details. So we will add that and maybe look at it. Perhaps, when we are ready. The details will take about a couple of weeks. By the way, most of the data that we have collected, we will give you some of the links. It's all there. It is just the time that you need to take to understand these things, put the perspective, and that's what is the key element here in getting it out to you. And Sridharji, if there's anything else you would like to add, we can wrap it up after that. We don't have any questions at this time, so I leave it to you, sir.
No, I think that the current stimulus will go along the same path that we had already given the breakup at a high level, close to $1.3 trillion to be towards the payments, $350 billion towards local and small business and state administration, and then of course we had given $300 billion towards the direct payments program. So that roughly makes up the 1.95 or $1.9 trillion we'd given. But some of the changes that are likely to come is this $15 versus 7.5 payments to these illegal aliens. Some of the other kind of small types of programs, which grants and other things, whether they would be written in the fine print or whether they will be removed. We need to be. That's part of this resolution. There's a resolution process. In the resolution process, there'll be again a voting for certain amendments that need to be incorporated. Once they're voted and incorporated, then that becomes the basic documentation for drafting the legislation and the stimulus bill.
Now, let's try to take a step back and look at how things are playing out in India. India has just released its new budget, and it's got views from left to middle to the right. And we have published all three views on PGurus. And in fact, we talked about it also a little bit.
Yeah.
My question here is that, there is a policy think tank that is funded by the finance ministry, the NIPFP, of which Urjit Patel, the former RBI governor, is the chairman now. And I think the world likes to watch, and the world needs to look at India in terms of the data that you have presented here today. Otherwise, it is difficult for people to come in and say, okay, this is where we will give the investment in India. Because what happens, in my opinion, sir, There are two challenges to that. India cannot give this thing because a significant portion of India's economy is informal. Numbers are not out there. Only 7% of India's population pays taxes. In the United States, it's 70%. And they pays taxes. And in both countries, everybody files, or at least almost everybody who makes a salary has to file. So there are some differences here. Now, if you are an investor to go into India to invest, what would be the critical things that you would look at before you say, I'll put in a $10 billion investment here?
Well, I think that's a great question. And we come from the investments are on this either on the supply side or on the demand side, right? So supporting the demand. Amazons of the world effectively, invest to tap into accessing and supporting the demand side of the business. Generally, people look at both sides. And so what are the things that we look at? We look at, first and foremost, what we look at is the growth opportunity that is available for any kind of business segment. That's number one. Second that we look at is whether a dollar invested has a linear momentum in terms of as an investor, or whether it has got an incremental multiplier momentum. So we are not going to invest if we are going to generate, let's say 7% return or 10% return. So on a 3-year basis or a 5-year basis, we are looking for any returns which are greater than 20% or 24%. So in other words, we are looking for minimum kind of a 3x to 3.5x multiple on a dollar. There are others who say, anything which is between 5 and 7x multiple is what they would look at in terms of the investment. That's the second in terms of the outcome. Now, you generate this return, then if you're going to pay 30% of that in local taxes and only the net, then there is no tax efficiency for us for the risk capital, right? So therefore, we are looking for favorable kind of taxes by way of long-term capital gains. We are not here for opportunistic short-term gains. Short-term gains are always taxed at normal income tax rates, whereas the long-term gains are taxed at a much more advantageous rates, especially if you are applying for risk capital. So that's another thing that we kind of look at. As I mentioned to you, we dipped our toe into India, into our funds. We had some challenges on the taxation side, right? So therefore, we could have generated 19% IRR or 23% IRR. By the time you pay the tax, your IRR comes down to somewhere between 6 and 8%. Now, if I invest that in the US stock market, I'm guaranteed 14% return. When I look at the average return on the S&P, all I need to do is put money on the index, I'll generate that type of return. Okay, so therefore, I think these are things that we look at and then of course the our ability to work with people, the understanding the complexities and the nuances, etc., etc., etc. So these are some of the facets that we look at as we look at the investing aspects of the horizon. The LIC dilution is a great opportunity. Some of the public sector undertaking dilution is a great opportunity because they are addressing massive segments of the market. I think that's where the opportunities come from.
Thank you very much, Sridhar ji. I think the astute viewer will understand where Sridhar ji is hinting about how India has become a thriving market for FPIs and FIIs, that is the stock market. Unfortunately, people don't realize that it's the population of India that's paying the price, and these things, they come in through vehicles such as Mauritius and Singapore and so on and so forth, and they essentially don't pay any taxes, and then they keep running up the stocks in the stock market. This is my pet peeve, participatory notes and its ills, but you understand now what it takes, the rigor that it takes to start attracting good investments in India. A good investment is an investment that will be over a 3 to 5 year period, which will generate a great multiplier effect in terms of jobs created. Whatever FPIs and FIIs are doing in the stock market, it is just a mere manipulation of numbers. I just wanted to put that thing out there. Sridhar ji, this is one of the most enriching conversations we've had today till date, and I hope the viewers see the value that is being presented at PGurus. And thank you once again, sir, for taking the time out. It took a lot of time to put the research together. And once again, we'll see you back, viewers, on Monday morning at 6:30 p.m. IST. Namaskar.
Namaskar and thank you. Have a wonderful weekend.